is now 6 p.m., which means it is time for Office Hours Q&A. We are Tax Sherpa, and let's just dive into it. Today is July 9th, 2024. It's Tuesday, it's 6 p.m., so it's time to get started. I'll give you the quickie version of how Tax Sherpa came to be. Here's a little bit about my story. So I realized early on, back in the year 2000, so almost 25 years ago now, that the corporate world was not for me. I had my initial experiences in it. I was like, nope, that's not going to work. And sorry for my shirt. I wore a green shirt today, and it's just doing a green screen on my shirt. So it's a little weird. But so I realized early on that working in the corporate world was not going to be for me. And that's what started my entrepreneurial journey. So from 2000 to 2010, I was doing this, doing that, tried a lot of different things. Some worked, some did not. Learned a lot of great lessons. And then in 2007, I started getting letters from the IRS. And the letters said that I owed them $1.3 million in taxes. Now, like most people, I stuck my head in the sand and I ignored it. And I'm here to tell you, don't do that. If you get nothing else out of this call, just don't do that. Don't ignore notices you get from the IRS. Because what happens, and I've been through this whole process, so I know, what happens is first you get a letter, and then you get another letter, and then you get another letter, and the letters keep coming every month or so. And if the number's big enough, then you'll start getting certified mail and where you have to sign for it. And I don't know what it is about like the UPS drivers and the FedEx and the post office. Like anytime somebody needs to sign for something, magically you're not home and you have to go to the place to pick up the mail to sign for it. I don't know if that's just you, if that's just me, but that seems to be everything I ever have to sign for that I learned. And they'll do that a bunch of times. And if you don't respond to those, then you'll start getting phone calls from revenue agents. I had one named Joyce. And they said, hey, you have to respond to this. There's this issue, blah, blah, blah. If you don't, we're going to come after you. And if you ignore those, then they start coming after you. And they'll go after whatever they can find, essentially. And this is where you see those old commercials on TVs, government auction from boats and planes and all this kind of stuff. That's where all that stuff comes from. That's one of the places. And they'll go after your house. They'll go after your boat, even your car. Now, at the time, I didn't have anything. I was in a low period then. But I did have a job. I had a W-2, and they garnished my paycheck. And so that got my attention because all of a sudden I couldn't pay rent, I couldn't buy food, I couldn't do anything. So this was about 2010 at this point. So this is a long process from 2007 to 2010. And in 2010, I started casting about trying to figure out how do I fix my problems. And I ended up, through my network of people that I talked to, I ended up getting hooked up with this guy who used to be on Wall Street doing tax attorney work for the specialists on the New York Stock Exchange. A lot of fun stories from that time, actually, back in the go-go 80s. But he helped me fix my problems. And it took about a year. And at the end of it, I didn't know any of that money, which was fantastic. It's just that I stuck my head in the sand. I didn't address my own issues, and then they grew out of control. So in the process of fixing all that, I started with this guy who would eventually become my mentor. And his tax business was starting to grow. So he was struggling to meet with client demands, and the number of clients he was seeing was growing. And so he was great at doing the tax work, had no idea what to do when it came to business operations. We teamed up, and over the next several years, we tripled his business, which was great. And basically, along the way, I was working in the business for him, and he taught me the tax game. What I didn't know at the time was that having somebody with that kind of experience, people talk about all the Wall Street fat cats not paying their fair share. That's absolutely true. And there's a reason for it. It's because they have good tax advice. I didn't know for many years that I was getting an education in the tax world that was not available to most. And over those years, we were super busy, working 100 hours a week for a decade. Ended up doing 50,000 plus tax returns on billions of dollars worth of client revenue. And I learned the tax side of things from the perspective of those fat cats, basically. And in 2020, weird things happened in 2020. I don't know if you guys remember, but I ended up going off on my own because my mentor had gone as far as he wanted to go as far as growing his business, and I wanted to do more. Little bird has to leave the nest. So I ended up founding Tax Sherpa, and the real goal there was to help my tribe. And my tribe is the solopreneurs, the small business owners, get their quality of life back. I've been a small business person my whole life after I realized the corporate world was not for me. And so these are the people that I aim to serve most often. And in the tax business, there are two very different camps. So on the one hand, there are the people specializing in high net worth and large companies and all that kind of stuff and doing tax strategy there. And they charge lots of money. I have seen, so I had one guy in one of my masterminds, he was talking about how he's billing a client for $126,000. I've seen another outfit that would charge $150,000 just for one tax return. Those are extreme numbers that most people have no connection with. And that's 1 or 2% of the tax professional world. And they do good work and they charge a premium for it. The other 98, 99% are your corner tax place, where you're pick your franchise. H&R Block, Liberty Mutual, or not Liberty Tax. Liberty Mutual is my insurance company. Jackson Hewitt, there's a bunch of them. And then just solo shops are out there as well. And they do a job, but what they're doing is not money saving. What they're doing is high-end data entry. You go in with your forms, or these days you might email your forms or whatever, and you say, here you go, and they put it in the computer, and they say, here's your tax return. You get a refund of whatever, $3,000, or you owe $10,000, or whatever the numbers are. But it's just reactive. But the goal here with Tax Sherpa is those people in the middle, the small business owners, the solopreneurs, can't afford $150,000 for a tax return. That makes no sense. And by default, you're left with the other guys, and they do nothing for you because they're just putting the stuff in the computer, hopefully correctly, right? Fingers crossed. So I've got stories. But yeah, fundamentally, those people in the middle end up stuck because they're not getting the advice that could apply to them. And they're left with just filing based on what happened last year, rather than planning ahead and trying to manage your tax issues going on a forward-going basis rather than reacting behind. So that's what we do here at Tax Sherpa. The whole point is to get your quality of life back. Now, what do I mean by quality of life? What I mean is answered by this question. So quality of our questions determines the quality of our life. That's a great Tony Robbins quote. So my question is, what is the root problem with overpaying on your taxes? Because you can. There's no law set that says you have to minimize your taxes. You could even go on to the U.S. Treasury and write an additional payment to them to the general fund of the United States. Perfectly optional. The last statistic I saw was like $113,000 worth of extra payments were made to the Treasury by probably one guy. I don't know. So my question, the answer to that question, at least for me, is 74 days a year. Because I don't know how old you are listening to this, but the older I get, the more important time becomes. So yes, it's great to minimize your tax liability. It's great to keep more money in your pocket. I love all those things. But what I love even more is the fact that I'm working for myself and not for the government. Because when you're paying taxes, you have to think about this. So there's 365 days in a year. Some portion of them, you are going to work and you're doing the thing that you do. You're earning money, and then you're taking that money and handing it over to the government. On those days, did you work for yourself? Did you work for your family? Did you work for your community? Did you work for the eventual charity that you might leave money to when you pass? No, you're working for the government on those days. So my goal is to get 20% is not a guarantee. It's just an average number we see a lot. Going from a 35% total tax rate when you include income, payroll, state, and all that kind of stuff, down to a 15%, or maybe going from a 20 to a 0, or 25 to a 5. There's just a typical difference that we see when we put into place tax strategy that works. And that translates to 74 days this year, next year, the year after, every year going forward. So that 74 days is time you have back for yourself. And to me, it doesn't even matter what you do with that time. Now, most small business people will reinvest that time into their business. That's just how we're wired. Too many people are workaholics, but that's just the reality of it. That's just how small business is. And the small business people, they generally love what they do. That's how they got into it, for the most part. I love what I do. Obviously, every job has its ups and downs, but overall, I get a thrill out of keeping money in my client's pocket rather than handing it over to the government. So whether you reinvest that time into your business or go on vacation or spend time with your family or volunteer in your community or whatever, even if, like I say, if you go to Vegas and put it all on black, that's still better than working for the government, at least in my opinion. So that's how you get your quality of life back, by taking the actual time that you spent working for the government and turn it into working for yourself. And what you do with that, it's up to you. So This is a Q&A, so we will answer some questions. Clients always have questions, and we get random questions from others. But here's the answer to all tax questions. Ready? It depends.
It depends.
And the next question people always ask is, what does it depend on? It depends on facts and circumstances. Those are the key words that you hear in the legal and professional world. Because what is true for one person with one set of facts and one set of circumstances is not true for another person with different set of facts and different set of circumstances. I'm trying to think of a PG example because there's some non-PG examples that always come to mind. But let's say your house burns down. Okay? This is the house you live in, and it burns down, and the insurance money doesn't cover the full cost to rebuild. You're still out 50 grand. Question, is that an expense? Is that a deduction? And the answer is, it depends. So it depends on when this happened, and it depends on where this happened. So what I mean by when is that the rules have changed over the years. So before the Tax Cut and Jobs Act, that was a Schedule A casualty loss, Form 4684, I think it's the form. And that loss would have been deductible. After the Tax Cut and Jobs Act, that loss is only deductible as a casualty loss if it is also in a federally declared disaster area. So if you had a house that burned down in Maui in a federally declared disaster, then it would count. If you had a house that burned down in Wichita in a not federally declared disaster area, just because your house happened to burn down because of bad wiring or struck by lightning or whatever, then it doesn't count as a deduction. Same idea, house burned down, but different facts, different circumstances, different rules. Okay. Now, why is it this way and why is it this way? We had a call with a client or a prospective client earlier today, and they were trying to get around to the question of why, if this is deductible and that isn't deductible, why is that? They're looking for some kind of principle behind why the rules are what they are. And I had to give them the answer. There is no principle. It's just, this is what Congress decided. There have been laws passed over the years, and different things are treated differently for whatever reason. Some of them make sense, some of them don't. And it's just how it is because we're dealing with legislation. And obviously, all the things that go along with legislation as far as remarks and political lobbying and all this kind of stuff. That's just what happens. Our job is to use the code as it is and use it to our best advantage possible, given your facts and your circumstances. So that's what it depends on. Anywho, that is my spiel. So Serena, what do we have as far as questions go?
We have a question from a client asking about their 1120S. They're making about 500K, and that's gross. Net probably about 300K. What are some good effective tax planning strategies for them to take? What are some good suggestions?
Okay, so after expenses, they have 300 grand. That's the basic idea?
Yes.
Okay, and you said it's an S Corp? Okay, you're already doing one step right, which is the S Corp. S Corp is a particular tax status as far as companies go, and it files its own tax return, and the net profit at the end of the return is going to flow through to the individual owners. And the individual owners pick up that income, but importantly, they get QBI treatment, which is a special deduction created by the Tax Cut and Jobs Act, and they get to take that income without self-employment tax. So a partnership, same kind of thing, but you have to pay self-employment tax, which is Social Security and Medicare. S Corp, you don't. So important difference. It's a 15.3% difference. So step one, you're already doing right. So as far as after that, how do you manage that? And actually, before we even get there, this is that's a little bit high on the expense side, because if you're bringing in 500 and you're left with 300, that means you spent 200, right? So 200 on 500 is 40%. So your operations expense is 40%, which is a little high for a small business. Generally, you want to see that 30, 35% maybe at that level, but that's a side thing. All right, so now we got 300 grand a year, and how do we take care of that? There's a million tax strategies, but there's a couple of basic categories. One of them is structuring, and that's putting things into an S Corp or C Corp or partnership or whatever it is. So you got the S Corp piece already, that's good. Second step is cash management, and that is going to involve what I like to call cash flow neutral strategies. And those are going to be reimbursement strategies and using a meetings plan and taking care of medical expenses, and a few other things that fall into that category where you are reimbursing yourself in a tax advantaged way. It's a little bit beyond the scope of this call to get into how all that works, but basically, when you have business expenses that are coming out of your personal pocket, you get reimbursed from that, or reimbursed for that from the company. You can have a meetings plan where you are using your primary residence for a business meeting. You can do that up to 14 times a year. You can do things with medical expenses. You can potentially do things with education expenses. You can, depending on your facts and circumstances, if you have kids in the right range, you can put them on payroll through a different entity. So there's a lot of different things, and that's all using the income and expenses that you already have, but just recharacterizing the flows into a more tax advantaged way. So that's the first set of things. And after that, then we get into salary optimization. One of the magic things that was introduced with the Tax Cut and Jobs Act was the Qualified Business Income Deduction, QBI. And this gives you up to a 20% deduction on pass-through income, like from S corps. So the math is complicated, but basically, if you're under a certain threshold, depending on your filing status, then you get a 20% flat rate deduction. If you're over a certain threshold, depending on your filing status, then there becomes a comparison between 20% of the income versus the wages that were paid by that company. And so there's some optimization to be done there, because on the wages side, you're going to have payroll tax, but you also have the potential to layer in retirement strategies once you have earned income. So the math gets complicated, and I spent literally years developing worksheets to actually account for all those things and do it in calculating the optimal amounts to take care of. Because what confuses a lot of people is that in a lot of cases, you actually want to pay yourself more on W-2 and raise your payroll tax in order to get a deduction on the other side. And then we can layer in, like I said, the retirement plan stuff. Okay, so that's category 2, optimizing all that. Category 3 is, once you get beyond that, if you still have $250,000 worth of taxable income, so taxable income, not just income, then there start to become what I call the exotics. And these are businesses that people sell membership interests in, or tax credits that people sell, or there's a bunch of strategies around this. The difficulty with the exotics, this is what everybody thinks about when they think about tax strategy. The difficulty with them is that it's a case-by-case basis. You have to look at, 1, the particular opportunity, 2, the business purpose or charitable purpose or whatever purpose behind that. We have people who have asked about conservation easements, for example. That's where you take a piece of real estate, you put a conservation easement on it, meaning that it can't be developed at any point in the future, and you get a tax credit for that. Those have gotten scrutinized a lot because people abuse them. And so you have to be very careful about the particular opportunity that is being presented to you. Is it real? Does the property exist? Are they really doing a thing? Are their appraisals real? All those kind of stuff. And then, so that's at the strategy level. And then at the individual levels, okay, if the strategy checks out, then how does it affect my particular case with my particular numbers? And so you have to do that analysis on a case-by-case basis, which is really what makes it difficult to give like a broad survey of the exotic strategies. But by and large, those involve laying out some level of funds at significant amounts, and then taking a tax advantage on the other side, as well as some other complication down the road. Because they all come with their own complications, and not complications in the sense of something bad's going to happen, but complications in the sense that there's ongoing stuff that needs to be dealt with. So that they're not easy, simple things that we just do this one thing and then we're done. I know that's a broad answer to that question, but it's a broad question.
That's true. I have another thing that I want to ask you. Yep. What is the drawback of the tax deferral strategies?
That's a great question, actually. So tax deferral is, like it sounds, it's a deferment. So the most common one is a retirement plan, right? Whether it's 401k or an IRA or whatever. So you put money into a special account this year, and your taxable income goes down by that amount, which is fine. Okay. The flip side is that because you got a deduction this year, in the future, when you access that money, you have to pay taxes then. On the surface of it, that sounds fair, right? Break over here, got to pay over there. It comes out even, but you get the break now, which is more important than later. And so that all works out. The difficulty comes in a couple ways. So one is that you've put strings on your money. So if you need to access that money, then you get penalized. So I've seen many cases where people put money into a 401k, for example, and then they decide I need that money for whatever reason. Some reasons are good, some of them are bad. I've seen both for sure. So reasons I would consider good would be, hey, my kid's going to college, or lost a job and I just need money, or medical emergency and I don't have money to pay for it. Those I think are all reasonable. The bad reasons that I've heard from clients in the past is I wanted to redo my kitchen, or I wanted to go on vacation, or I wanted to pay off my house, which just blew my mind, because why would you take 40% tax money and pay off a loan that you're paying 4 or 5% interest on? That makes no sense. But it was done. And yeah, so there's good reasons, bad reasons to do it. But whatever the reason, if you take the money out, one, you're probably taking out a big chunk. So your marginal rate is going to go up. So if you were in the 24% bracket the year you put the money in, and then you take out the money and you've increased your income so that now you're at the 32% bracket, you're already behind. And then on top of that, you're going to have a penalty if you're younger than 59 and a half, which most people doing this are. So now you have whatever your marginal tax bracket is plus 10% on top of that. So it becomes very expensive to access that money. Now, there are strategies to deal with that. In some programs, you can take loans, like 50 grand or something like that. But each plan has its own rules. Some of them allow for hardship loans, some of them don't. Some of them will do this and some of them will do that. So it just depends on, again, case by case basis. So that's downside number 1 and 2. Downside number 3 is that fundamentally, we don't know the future. So if you talk to financial planners and you talk about these retirement accounts, the pitch is usually the same. It says, yes, you are going to have income that you have to take in the future, but you're going to need less income because your expenses are going to be lower when you're talking about the kids are out of the house and blah, blah, blah. And sometimes that's true. A lot of times it is not. So one, we have to deal with the effects of inflation, because we're talking about, if you're 45 and you're talking about pulling the money at 65, that's 20 years. So the numbers that you're talking about now have nothing to do with the numbers in 20 years because of inflation. So cost of living is going to change. The tax brackets are going to change. The tax rates will definitely change because Congress will pass some law sometime between now and 20 years from now that changes how things are taxed. I can virtually guarantee that. And you're trading a known cost today for an unknown cost in the future. Now, sometimes it works out, sometimes it doesn't. It all depends on what assumptions you build into the model. It's not as clear and easy as a lot of the promoters of retirement plans will put into it. Now, there are other kinds of deferrals, like a deferred sales trust, where let's say you sell a business and you don't want to take the tax hit all at once. And so you put it into a special trust that doles out the money over time. That has its place. That does not have quite the same strings as like the retirement account money does. The trade-off you're making there is you're taking income over time rather than all at once. And depending on your financial situation, that may or may not make sense. Most people want their money now. I can tell you that from experience. Even though the tax rate is higher, most people end up going that way anyways. So that's another, not necessarily downside, but it's a trade-off. So that's always, that's always the case. It's always a matter of trade-offs. You're exchanging this thing for that thing. So with retirement accounts, known impact for unknown impact, free use versus a lot of rules for that money. So those are the kind of two basic ones. And by far, that's going to be the biggest issue when it comes to deferral.
Okay. So another question, it's about audits. So we have someone that received a notice from the IRS about an audit, and they're worried because they're saying back in the days, audits were very extreme. Is it the same way now, or has things changed?
Things have changed. So a couple things have changed. So one is that the majority of audits now are correspondence audits. The days of you getting hauled into the office and then grilling you under a fluorescent light, those are pretty much gone. Most things are by mail. You get a letter, they'll say request for explanation of items, and they'll list out we want to ask questions about these 3 things. Send us your documentation, and we'll get back to you. So even those, they come in these big manila envelopes and they're these thick documents. Even those most people don't respond to. So if you don't respond, the IRS just makes its decision. I'll give you a hint. In their decision, you lose. And then they give you an assessment. Audits are, I don't want to say friendlier because they're not, but they're easier in the sense that you're just going back and forth by mail, sometimes by phone if it's a big issue. Now, that the downside of that is that they take a lot longer because it's all this back and forth, going back and forth with the mail. The IRS is implementing an upload portal. I am highly skeptical about this portal and how well it will work, but they are trying as far as to get information flowing back and forth more quickly. They say, I think they're saying by the end of this year, it'll be functional for everybody, but to see. They said that for a lot of things. That has not ended up being true. That's the main thing. Now, the difficulty with audits is not so much even the final like dollar amount that ends up happening, because here's the basic thing with audits. They're questioning some particular aspect of a tax return. And let's just assume we're talking about individuals. Every year they pick a pet issue and they'll audit this thing more than other things. You can also get your name picked out of a hat just randomly. That does happen. Let's say this year they're picking charitable deductions. And we never know for 2 or 3 years because that's how far behind their audit cycle is. So they'll say, let's charitable deductions. We're going to audit 700,000 charitable deductions this year. And if you're in that bucket of 700,000, then you get audited. They'll send you a letter. They'll say, we need an explanation of all these charitable deductions you have in your tax return. And that kicks off the process. So let's just say you come up, you have no documentation to back up your charitable deductions. So they're gonna close the case saying that you are not entitled to this deduction. They're gonna reassess your tax return and recalculate the tax owed based on that change. And they're gonna probably, depending on the numbers, they might also assess you a penalty of potentially 20%. And then the whole thing carries interest. Depending on the issue, it can be a minor amount or it can be a significant amount. It just depends on what's going on. But whatever it is, it's a dollar amount you owe. And what most people do is they end up setting up a payment plan and they pay it over time. It's definitely a burden, but it is not the end of the world. The problem with the whole thing is the process. The process is the punishment. That's the whole thing with audits, is that it is such a time suck and an emotional burden going through all this that it is just sapping your life. The real goal is to do things in a way that are reducing. It's never zero, but you'll want to reduce your risk of audit as much as possible. Actually, we have a checklist of red flags that these are things that will definitely create audit issues. We had somebody come to us last week or the week before, and they were saying, hey, I got this audit for 2021. What's going on? And this guy was doing his own taxes and did what I rail against constantly with business owners, is that he filed a big loss on a Schedule C against W-2 income. Now, I know that sounds technical, but basically what he declared on his tax return was that he lost a whole bunch of money on a side business, and it was done in a way that raises questions automatically. That makes perfect sense that he audited about it. Now, in the positives of his thing is that he did have real expenses that, to a real side business, but it just was done. It was filed in such a way that it made the IRS suspect. And then he got this notice, and then he didn't respond to it, and then the IRS made their own conclusions, and now he's in the position that he's in. We're working with him to see what we can do there, but you want to avoid that go on the front end, because again, the process is the punishment. So even if there was nothing we could do for him and he owed whatever the dollar amount is, that's still, you can deal with that. It's however many dollars, but it's just back and forth and sleepless nights and, oh, they could come after me. And I've been there. If you remember my story, that was like 3 years of this stuff, or 4 years of it, whatever it was. Understand all the angst. Mine wasn't an audit. Mine was an SFR, which is a slightly separate thing. Every year when tax time rolls around, you'll see all these articles about how, or you see these memes and clips on YouTube or TikTok or whatever. And there'll be this scenario, if the IRS already knows what I should pay, why don't they just tell me rather than me having to go through this thing? And the answer is that they don't know. That's the whole point here. That's what a tax return is. However, if you don't file anything, then they will, after a couple of years, they will do an SFR, which is substitute for return. So they will make up their own tax return based on the info that they do have from third-party sources like W-2s and mortgage interest and whatever. And they will make the worst possible assumptions on your behalf and then come up with a number. And if that number is that they owe you money, you will never hear from them. If that number is you owe them money, then you'll start getting letters, which is what happened to me. They filed SFRs for, I think, 2003, 4, and 5. And then it showed them I owed them $1.3 million. And so I started getting letters. But as it turned out, that was all incorrect because the way they built their return was wrong. And I had to then prove that fact. So it was a painful process. Audits are not like they used to be. However, they're still not fun, and I don't recommend them. So right. That's the short version, is do things the right way the first time, and you reduce your risk of getting audited.
Neal, we have a retirement question.
Alrighty.
So what's the difference in retirement accounts that we can contribute to impact the taxes?
There's a bunch. So let's see. The most common ones that you'll hear about are an IRA, which is an individual retirement arrangement. Actually, does not sound for the A does not sound for account. There's 401ks, there's 403bs, there's simple IRAs, there's SEPs, Simplified Employee Pension Plan. There's a couple other, the code sections for, and then there's a whole other beast called a QRP. So I'll talk about that one first for a second. A QRP is basically a qualified retirement plan, but it is much more powerful than the other things. Because like a 401k in 2024, the maximum you can contribute between you as an employee and your employer doing matching is $69,000. A QRP is like $270,000. So it's 4 times more powerful. The problem with QRPs is that they tie into actuarial calculations. And so generally you have to pay into them for at least 7 years at high levels in order to be able to use them, because it's getting too technical, but basically you want to avoid creating a modified endowment contract because you lose the tax deductibility of things and the tax-free growth. If you have a super high income that is reliable for a long period of time, then QRPs become viable. For everybody else, which is the vast majority, then the more standard ones, the 401ks and all that kind of stuff, are applicable. As far as which one to use, it's going to depend on your business structure, and it's going to depend on your numbers. Most of the time, 90+% of the time, the most efficient thing to do is to use a 401k. And that's because you get contributions from the employee and the employer side. The employer side is limited as 1/4 of the wages paid. And so an SEP has the same 1/4 limitation, but there's no employee contribution. So you're just stuck with 1/4 of the wage, and you can't kick in on the employee side. 401k, you get 1/4 of the wage plus the employee contribution. So you get to hit them more efficiently than with SEPs. Like I said, most of the time, 401k is going to be the way to go. IRA is going to be a lesser version. I think the limit this year is 7,500, maybe. Changes a little bit every year. Might be 8
Yep, it's 7,500. No, it's 7,500. Yeah.
Great. Great. That is not tied to your W-2. It's just a separate deduction. And whether it's deductible or not depends on how much you make and whether you have employment or you have retirement options from your employment. But by and large, that is viable. Also, question then becomes, do you want to do traditional, where you get the tax deduction? And we talked about earlier how you have all the issues with the deduction now versus the income later. Or do you want to do a Roth version and you take the tax hit now for a tax-free benefit later? So I will warn you that here's my tinfoil hat thing. Now, I'm not saying this is likely, but I am saying this is possible. There is the possibility that as the government gets broker and broker, then there's the amount of money that's in retirement plans is roughly equal to the 30-something trillion dollars. So there's this enormous temptation for Congress to go in and just take that money. So I'm not saying it will happen, but I'm saying it did happen in Poland. And that was in 2010, something like that. So Poland had a different retirement plan, structure, but roughly similar. And one morning, And they always do these things on the weekend. But one morning, Monday, everybody woke up and all of their retirement investments were replaced with government bonds, dollar for dollar. So if you had 100,000 zloty or whatever the Polish currency is of investments in your retirement account, you woke up with 100,000, same currency amount of government bonds. And the government said, thank you very much. We did not shortchange you at all because dollar for dollar or zloty for zloty, it was equal. But now you're making 2% on your government bond rather than investing in whatever investments that you had. So in my darkest days, that's what I worry about when it comes to retirement plans, because all of these things are created by Congress. They can all be changed by Congress, and they have been various different rules. They could take away the whole thing potentially. I don't think that would happen, but the government bond swap, I think, is viable, and it worries me. But the chances are low because the political backlash would be unbelievable. But it's within the realm of possibility.
Understood.
Hopefully, it's not too scary. But
so we have another client asking about. They wanted to know if you can share a success story where your tax advice really helped the client.
Oh, I mean, I've got a billion of them. Narrow it down for me, Serena. Who should we talk about without using names?
Dentist.
Okay, dentist. I know who you're talking about. So this guy he's a dentist. He was making good money, and by the time he came to us, he owed about $100,000 worth of taxes from the last couple of years. And so we were able to go in and fix some of his old returns and take that 100 down to like 60 or 40, somewhere there. It's roughly half by fixing the errors that he made on his own tax returns. And then we were able to restructure him and put into place the tax strategies that we talked about before and end up generating refunds from the current year and the following year, and ended up able to wipe out the full back tax issue, which was fantastic. And he's super happy. and one of the things that he has told us is it goes back to that emotional weight part, because so his issue wasn't an audit. He just owed money and he was paying it. He was paying monthly, like $2 or $3 grand a month. So it was a burden, and it was just this weight weighing on him. And then we were able to go in and clean it up. And it was a multi-step process because he built up such a problem for himself. And it took 6-8 months, something like that, to get all the filings done, because you got to wait for one to process so that it readjusts all the numbers, and you got to do the other one. Because in a situation like that where there's already arrears, then if you don't do it in the right way, that they can assess it to the wrong year. You have to work with the IRS. You got to be patient with them because they take a long time. However, we were able to go through the whole thing and end up wiping it out. And he's told us how he's felt this burden being lifted, and he's able to live his life and work his business more effectively, which is great. Yeah, so that's a $100,000 swing. I can tell you the biggest swing that I've personally done is about $6 million. That was a larger company, obviously, but to save them a ton of money on taxes by implementing specific strategies to that industry. We had one of my earliest clients that was just mine rather than when I was working for my old mentor. He had a business. He was in marketing, and he owed $100 and something thousand on a particular year. He had a good year. And I started going through his tax return, and I said, what about this? What about that? What are these things? What are those things? And as it turned out, the previous accountant had just mischaracterized things as personal rather than business. So we were able to file an amendment. And because what it was, some credit card charges that he was spending on advertising that the accountant assumed was personal, never checked. And we were able, and advertising is a big part of marketing. So we had an enormous ad spend. And we were able to do a full turnaround between the federal and state. I think it was about $180,000. He ended up getting a refund. So like he owed 100 and something, and then he got a refund of 50, something like that. And that was a great swing. So yeah, tons of stories. The people we see over and over again, as far as they come to us, they're in a certain position, and then after we're done with them, they're way better off all the time, like daily, somewhere in the $20,000 to $50,000 range. That's stuff we do all the time. The bigger swings do happen depending on the numbers, but as far as like commonplace, yeah. So in that range is all the time.
We're giving clients peace of mind.
Yes. There's kind of 3 different categories of tax issues. On the one category, people just feel overwhelmed. They've got some outstanding issue already. There's another group of people that They just know that they could be doing better. And the net result of what it is that we do is that we put into place a plan so that you have an expectation of what happens at the end of the year. And I think honestly, that's actually the biggest part, is that you have a level of comfort with the certainty of what's going to happen. So rather than the anxiety of the unknown, you say, okay, our projection is this, and we refine that over the course of the year. And then at the end of the year, we're usually pretty close, unless something wildly out of whack happens. We had a case last year where a particular client had a huge second quarter, and we talked to them about it and said, okay, should we build our projections based on the second quarter? Or is business going to continue like this? Or is this like a one-time thing? They said, oh, no, this is going to continue. It's going to ramp up, et cetera, et cetera. And that ended up not happening. We made our third quarter and fourth quarter adjustments. We were still too high because we had such a big second quarter. And so they ended up with big refunds. That's not the optimal way to go. We generally want to be in line with projections so that we're pretty close by the end of the year. And that's normally what happens. But weird things do happen in life and in business. So by the end of the year, what you want to be doing is saying, okay, we've planned for X and X has happened. And so I just know that, and I have no surprises. Because when it comes to the tax world, surprises is not what you want. But yeah, removing that anxiety and that burden is the whole thing. Not the whole thing. There's the dollars too, but it's more than the dollars is the emotional relief that people have from having a plan and then coming in line with that plan.
Neal, that actually brings me to my next question, which is, what is the difference between proactive and reactive tax planning, and why is it so important to basically do the proactive planning part?
The simple answer is that reactive tax planning doesn't exist. So for the vast majority of things, after the year is done, you're stuck, whatever happened. And if that worked out well for you, then great. If it didn't work out well for you, then you're stuck with it. Proactive planning means, okay, we're going through the year. Okay, we just finished June, so we're halfway through. We look at our numbers. We say, are we on track, or how are we tracking based on our revenue and our expenses? My particular business has this kind of seasonality. Back half of the year is typically a little bit lower or a little bit higher, whatever the case is. And you go in and you say, okay, if we do nothing, here's how we're trending. Revenue, expense, profit, tax bill will be X. And then knowing that if we layer in strategy 1, 2, 3, 4, then we take that tax level and drop it way down. And that's the power of planning ahead and knowing where you're going rather than reacting. And so it's, if you don't have a destination, any road will get you there, right? Because you're not aiming at anything, right? But if you have a destination and you know where you want to go, then you can map out the route to get there. And then the way we talk about it as Tax Sherpa is that there's 4 steps to tax being proactive. There's the survey, which is figuring out where you are right now. There's once you know where you are, you can figure out where to go, and that's your route. So based on your facts and your circumstances, like we talked about earlier, you can do this, that, and the other. Strategy 1, 2, 3, 4, 5. Once you have the route, so you know where you are from the survey, you have the route of where you could go, and that's the map and the destination. Then there's the trek. You got to go from point A to point B. And along the way, you want to do your compass checks. That's step 4. And it's checking up along the way. It's typically every quarter, sometimes twice a year, depending on the situation. You want to say, okay, our projections were this. Is that where we are? Okay. And if yes, great, let's keep going. If no, we got to readjust. So like the client I was talking about earlier, had a big Q2 last year, or I guess at this point it would be 2022, or no, that was 2023. I had a big Q2, and we built our projections based on that. And then we did our compass checks, and we said, oh, that's actually not where we're headed. We got to adjust. We got to change this. We got to change that. All of that, the process by which you get to your destination. Like I said, if you have no plan and you're just reacting after the fact, you're going to end up wherever you end up. And almost, I'll say 95% of the time, that's not going to be the best place you could have ended up. A couple times you get lucky, but by and large, planning ahead will actually create that time savings and that dollar savings. Whereas being reactive after the end of the year, there's a couple things you can do. Like you can do late 401k contributions, stuff like that. But most of the things you're stuck with.
Understood. Neal, for clients with high net worth coming in, How do you address those clients? What are some unique tax challenges or strategies you use?
Yeah, it depends on the character of their high income. So we've had some clients who just work in the tech field. They just make a ton of money on their W-2, like $400,000, $500,000, $600,000. And the thing about a W-2 is that it is an external factor that we can't change. So we are somewhat limited in those cases. Unlike a business where you have a lot more flexibility as far as how you treat things and the options that you have. So the first thing is that it depends on that. What's the character of their income? Is it a huge capital gain? Is it a W-2? Is it business income? Is it this? Is it that? So from there, then we make our analysis as far as what strategies will apply. And again, it's hard to give a general answer to this because it just depends. But we look at things like business structure opportunities, we look at tax credits, we look at charitable strategies. So there's many different flavors of opportunities that are available depending on the character of the income. And that's just a matter of going through that process. Like I said, we do the survey, figure out where you are, and then from there we can do our route and figure out what applies to you. What destination can we reach based on your particular facts and circumstances? And that's the short version. We don't have time to get into the longer versions of that, but that's the basic idea. All right, I think that's going to be the last question for today because we only have a couple minutes left. So, final slide as far as next steps. I need to revise this slide actually. The cash flow neutral strategies I talked about, you can actually get those from us, taxsherpa.com/templates. Just go there. You can download those. They're $7, which is definitely 1,000 times cheaper than they should be. but what you get there is our master tax planning worksheets. These are the same worksheets that we use internally, and the business Basecamp tax guide, as well as the tax filing checklist, how to avoid IRS red flags. That's just a checklist of things to make sure that you're not doing that will automatically cause you to get one of those letters, because you definitely don't want to do that. So the thing that's changing with that is that I'm in the process of building a DIY course on how to do your own tax planning. And this is critical for people who are new in business and or people who are making basically less than 100K. Because here's the sad reality of it, is that for the people who are under 100K, as far as annual earnings, there's the work that we do takes too much time and too much effort to make that make sense for you. In most cases, sometimes we can still make it work, but by and large, it's just the labor that goes into all of this it's a lot. Taxes are complicated, and having all the moving pieces go through is just a lot of work. So what the course is for those people who are either new in business or who are underneath that threshold, and so they can DIY this whole thing. And these are the basic strategies that work with every business, and then basically it gets you to either a tax-free status or a nearly tax-free status or a greatly reduced tax status for your business. And then once you're able to reinvest that time and that money into your own business, because now you're working for yourself rather than working for the government, then you can grow your business to the point where you are making that 100K and we can come in and make a huge difference for you. So that is still in the works. We should have that done hopefully in the next month, fingers crossed. But for now, you can get the base level of all that stuff from the templates. Templates are the core of the whole thing, but the course is going to be more in depth and go over the wider context of how this all works together. But you can go ahead and do that. And then otherwise, we'll do this each week. The last couple weeks, I've been out just because of illness and things. But Tuesdays at 6 p.m. is our standard time. And I've already set up the event for next week. So I just have to change the link on the live so that it redirects there. But yeah, we'll do this all over again. And with that, I think we'll wrap it up. Any final words, Serena? Oh, you're muted. I think you just said no.
I'm sorry, but come see us at Tax Sherpa.
Come see us at Tax Sherpa. Yeah, absolutely. And like I said before, our whole goal is to get that time back for yourself. And I want you to be working for you rather than for the government. That's just how I feel about it. All right. We'll stop it there. Catch you guys later and see you next week.
Have a good day.